two, one, starting the webinar now.
Hi, everyone. Hi, everyone. Welcome to the third webinar of the Latin American Tax Policy Forum. My name is Lucas, and I am the founder of LATPF. I am also very happy to be with you all here on Zoom and
So,
YouTube.
one, start.
Sorry?
No, I'm so sorry. That was my mistake. You can continue.
No, it's fine. So I'll start again just for the recording. Hi, everyone. Welcome to the third webinar of the Latin American Tax Policy Forum. My name is Lucas. I am the founder of LATPF. I am also very happy to be with you all here on Zoom and YouTube. This is the LATPF webinar with the highest number of registrations we've had so far, and I'm sure that this is a uh, combination of the popularity of the topic we will be covering today, as well as the reputation of our guest speaker, who I have cited many times in my articles. Before I introduce him, I would just like to remind you that the Latin American Tax Policy Forum is open for individual and institutional memberships. Today, members can access a curated section of recommendations to more than 3,000 articles to over 100 from over 100 Latin American journals. The mission of the forum is to give visibility to Latin American tax policy content because, as you know, most of those articles are not read, and if they're read, they're not cited, and if they're cited, they're not cited outside of their countries of origin. And that's what we hope to change. So members can also get access to our monthly reports, the latest of which discusses the taxation of the art market in Latin America. And to become an individual member and support our project, all you have to do is go to our website, latpf.org/membership. And if you want to become an institutional member, like a law firm, a consulting firm, a think tank, or a university, all you have to do is send us an email at latpf@latpf.org. The title of our webinar today is LatAm and the Global Minimum Tax, Comply or Defy. And for the uninitiated, this is about the OECD Pillar 2 Globe Rules, which are designed to ensure that large multinationals pay at least a 15% minimum tax on their excess profits per jurisdiction. Pillar 2, of course, is more than just the Globe Rules. But as I explained in a series of 3 articles I wrote for Tax Notes, the other part of Pillar 2, known as the Subject to Tax Rule, has been largely forgotten. The so-called STTR-MLI has been signed by just 10 countries, only 2 of which are members of the G20. This can change, of course, but today's event is specifically focused on the Globe Rules. So this slide just has sort of a summary of what the rules are and why do they exist. Here is a newspaper article that was recently published in El País with a report produced by Fabian Birnbaum from Uruguay. He spoke with tax experts in 7 countries and provided his input on the state of Globe Rules in Uruguay. As you can see, apart from a deviation of the domestic minimum tax in Colombia, the adoption of a QDMTT in Brazil, and the upcoming adoption of the DMTT in Uruguay, Latin America has so far taken a passive stance in relation to Pillar 2. In other words, LatAm jurisdictions, and especially those that are members of the OECD and the Inclusive Framework, know that other countries may impose top-up taxes on groups that have a presence in their territories, even though their governments are aware of it. So far, they have chosen to wait and see. So that's the predominant position of governments in the region at the moment. This can change, of course. It all relies on what's going to happen with the side-by-side system, what's the future of the rules, whether the EU Court of Justice is going to say that the UTPR violates their directive, and so on and so forth. So our topic today contains a question: should we comply with or defy Pillar 2? There are 2 clear benefits of adopting Pillar 2 and setting up at least a QDMTT. One is that you do not need to revise your entire corporate tax system to ensure that companies pay a minimum tax of 15%, though that's not what Colombia did. And 2, your QDMTT can block the taxing powers of other jurisdictions that have implemented an income inclusion rule, or IIR, or the infamous undertaxed profits rule, or UTPR, a non-qualified DMTT would at best increase your local income tax, but would not necessarily block an IIR or UTPR, at least as the rules stand today, October 15, 2025. Last thing before I introduce our speaker, I would like to do something I did on a webinar that I presented for the University of Concepcion in Chile. I'm going to keep quiet, mostly quiet, and I'm going to just ask you to look at the next few slides. I'm just going to show you a few slides and ask you to look at them, and then I promise it won't take long, and after that, we're going to start our talk about Pillar 2 in Latin America. So, first slide. Okay. Second slide. Right. Now for the next slide. Yeah. Finally, the next slide. And then this. Okay. Next slide. This one is a bit more text. Yeah. And the last two slides. This. Yeah. And this. Make of that information what you will. Today, we are happy to welcome Professor Leopoldo Parada as our speaker. Professor Parada has an extensive resume, including teaching and lecturing experiences in some of the most prominent universities in the world. He's currently a reader in tax law at King's College London. Leopoldo, it is our pleasure to have you here. We haven't met in person since just before the pandemic in Lisbon in early 2020. Hopefully, we will meet in person in Curaçao next week, in which I'll speak about taxation and AI. And to get things started, I will remove the presentation so that we can focus on each other. To get things started, my first question to you, sort of a broader question, which I just want to give to hear your views on pros and cons for Latin America of legislating Pillar 2 right now. So considering October 15, 2020, we're yet to see what the side-by-side system is going to look like, if it is going to look like anything. But right now, in your view, what's the benefit for Latin America of adopting any Pillar 2 rule, whether it's the DMTT, the IAR, or the UTPR? The floor is yours. Thank you very much.
Thank you so much, Lucas, and for the invitation. And of course, it's always a pleasure to see you. It's true that we saw each other a long time ago, so in person. So I hope that next week we'll see each other again in person. So coming to the question, I would say that I've been thinking a lot about the potential benefits of countries, particularly Latin American countries, to go ahead with Pillar 2 right now. And the only reason that I think that can still, have some, let's say, prominence is the idea of the reputational cost of not doing anything. So what I'm trying to say with this is something very simple. The G7 agreement a few months ago demonstrated something very obvious, which is that beyond the altruistic message of limiting tax competition, beyond the idea of setting up, this floor of 15% and tax justice and whatever you want to put on the table, to justify Pillar 2, what was really demonstrated with the G7 agreement was the idea that everything depends on the dynamics of powers in which we are all involved. All countries are part of that. And now we need to recognize that within that dynamics of powers, there are countries that they have more powers than others, and I don't need to mention those, right? So it was a demonstration that the rest of the world is trying, to adapt, to the exceptional rules that the United States, has. Why? Because of course, if we want this to succeed, we need the United States on board. So if countries, Latin American countries particularly, decide to do nothing, there is a high cost in terms of reputation if the rest of the world tend to follow this dynamic of adapting, to the special requests of the United States. And of course, I could say the stubbornness of the Europeans, to continue with this project that perhaps, was a little bit adopted in a rush. So things as they are, Europeans, they move on very, very quickly into implementing Pillar 2 in 2022 when they adopted directives in Europe. They require unanimity. They got the unanimity, but suddenly now they see in a very difficult position as well, because they need to indirectly, benefit multinationals that they are headquartered, at least the ultimate parent entity is located in the United States, and they will have, the benefit of not being taxed, with UTPR, with the IAR, while, when you have a multinational group operating exclusively within Europe, that necessarily, it might happen. So the dilemma of Europeans today is that, well, maybe we move too fast, but it's very difficult, to retract that and say, now we need to wait and see. And on the other hand, for Latin American countries, the issue is that still the United States is one of the main commercial partners for them, right? So everything depends, how the United States will see the application of Pillar 2 in Latin America. Now, one thing, Lucas, that perhaps we need to think about is, even in the situation that Latin American countries decide to do nothing, so let's leave the Europeans with the directive, let's leave the rest of the world with the side-by-side system. If Latin American countries today say we won't have Pillar 2, there can be a very interesting situation in which investment can be easily redirected using Latin America, using Asian countries that they are not part of Pillar 2 for a very simple reason. If you have a multinational headquartered in the US, and you are potentially subject, to taxation, on Pillar 2, top-up tax somewhere else. You have the side-by-side system in Europe, which will exempt you from UTPR. So it could be that you structure, your whole group in a way in which you use Latin American countries ultimately not to be subject to a QDMTT, for example, right? So that's quite interesting, because before we didn't think about that, right? Before, the whole idea was everybody's implementing this. And as everybody's implementing this, at least you will need the QDMTT. And you need the QDMTT also because it will give you more revenues, and we went into this sort of argument of saying this is good for you, so don't let someone else to get your revenues, you will get that. But now the idea is very different. Maybe you don't need a QDMTT even, right?
I see. Yeah, I think that I remember that I said this to a Peruvian insurance Companies Association, which is that you might not need a QDMTT, but a QDMTT would help you block the imposition of an IIR or a UTPR in most cases. So it's something to consider policy-wise. I think that today we could of course do nothing. Brazil has already moved ahead with a QDMTT, but most countries in the region haven't done anything. And even as I've shown in the slide, there are some countries, Bolivia is an example, in which it's not even likely that they will adopt it because the whole campaign of the president that took charge of the country is that they're going to reduce taxes and they're going to attract investment. They're not interested in increasing taxes, even if it's just on a small group of large multinationals. The other point, very importantly, is the 750 million euro threshold is a mirage. After Pillar 2, if Pillar 2 is implemented across the world and tax administrations get used to it and the large taxpayers get used to it, that limit is going to come down. And then after 750, maybe it's going to be 600, maybe 500, maybe 250, maybe 100. After everybody is so used to Pillar 2 that it becomes this standard for corporate tax calculations just to ensure that a minimum tax on income is imposed. But you touched on a very important point, and I just wanted to hear from you about that, which is comparison in terms of the feeling, the perception of Europe in relation to Pillar 2 as opposed to Latin America. From your perspective, are Europeans just focused on compliance? Do they just think, well, the rules, a version of the rules is going to be implemented? Whether the United States agrees or not, we're going to go forward with the rules. Is that the mindset, or are countries in the European Union, perhaps Hungary, perhaps other countries, are they perhaps a little more cautious about the future and perhaps second guessing their decision right now?
That's a very important question, because I would say in Europe, what is happening right now is perhaps, a feeling of embarrassment. We did something a little bit in a rush, and it was completely unnecessary because the rest of the world didn't follow. And interestingly, I think it was last week, 3 different finance ministers of different regions of Germany, they called for the suspension of the directive. So think about the implications of that. So Germany and France were the countries initiating the idea of having a minimum tax. Actually, I would say it was Germany supported by France. And it's very interesting that now we have Germany realizing, wait a second, the position in which we are right now is a position that put our European multinationals in a disadvantageous situation vis-a-vis US multinationals. If we go ahead, things as they are, we will end up affecting potentially our own multinationals operating within the internal market. And this is something that I tend to explain it, in different fora, because not many people are aware about European law, but European law it works on the basis of the concept of non-discrimination. So when we have a situation like the side-by-side system, right? So we give an exemption to a multinational that is headquartered in the United States. The ultimate foreign entity is there, having a subsidiary in the EU that cannot be taxed, and the UTPR cannot be taxed, and the AR, if that's an intermediary parent entity, for example, it won't be triggered. If we have a multinational group headquartered in Germany, operating in Sweden, Italy, France, Spain, and the UTPR might be triggered in those cases. An IAR might be triggered in those cases. That is an issue that goes beyond tax competition. It's an issue of competitiveness. Because when you look at the situation of Europe as a single market trying to attract investment, it's not an issue isolated for Germans, for French, for Italians. It's an issue of Europeans. And the problems of Europeans right now is that they have a directive which is a hot potato, and they don't know what to do with that. So my feeling is that there is a lot going on, both within the European Commission in terms of what to do with this. Now, and at the same time, in the Parliament, in terms of discussion, I was recently, the European Parliament, there is a feeling as well of we need to take some decisions about what will be the future. Now, why I do believe that Europeans will go on anyway? Because Pillar 2 is at the end an ideology, right? It's beyond, just a simple tax policy. Is there, to remain, and there are very strong forces, that they want this idea of minimum taxation to remain and to be exported beyond corporate income taxation. So don't forget that as soon as Europeans, they had a directive and we were trying to accommodate to this new world of minimum taxation and corporate income taxes, some people, they said, well, we also need minimum taxation for individuals. And maybe that goes not only for very wealthy individuals, for everybody, at some point, as you said, all these thresholds, are just nominal, right? They can change at any time, So then is the idea of minimum taxation that is trying to be imposed. And that, I think, is very difficult at this point to be changed, because there are very strong forces that they pursue this ideology of minimum taxation as a sort of a holy grail for tax systems around the world, right? So
Yes.
I see Europeans continuing on that, even though they know that they will affect themselves, and their competitive position vis-a-vis other markets.
Very interesting, Leopoldo. I was thinking of, well, first of all, you mentioned Germany, and in Pascal Santamans's memoir, he says that Olaf Scholz, former Chancellor of Germany, was the godfather of Pillar 2, and at another point he says that he was the champion of Pillar 2. And now he's been replaced by Friedrich Merz, and he said in a recent commentary or interview, he said that it has no future. The Pillar 2 has no future. And then you see the three representatives from three very important states. Just these are not minor states. Bavaria is not a minor state in Germany. It's a very important state. And they say, this is it doesn't make any sense for us to continue with this if the United States is not going to implement it. Of course, another point is, and I think that they're playing this game masterfully, China is never mentioned in these discussions. As if China had implemented Pillar 2. They have not. They have not implemented Pillar 2. They don't have any plans of putting Pillar 2 in place. They have their own plans, their own view of global tax policy. And the US, China, and India are together in this because they think that it doesn't make any sense in terms of competitiveness. But I have a question about a specific part of Pillar 2 that I wanted to ask you. But what we see, sometimes we see on the web, on the internet, the so-called defenders of Pillar 2. And you said very appropriately that Pillar 2 carries an ideology. Basically, this view that there should be a minimum tax on the profits of large multinationals and perhaps on the profits of multinationals in general. We don't know what the threshold is going to be in the future. But the defense of Pillar 2, and I say this in the article that is coming up next month on Tax Notes, is that they make you forget the rules and focus on the principle of making sure that large multinationals pay at least an effective tax of 15%. And then they ask constituencies via their representatives whether they agree with that premise, with that principle. A lot of them would agree with that principle. If I were to poll Brazilians today, and if I were to ask the question without any sort of detail, just ask the question, do you think that multinationals should pay a tax of at least 15% on their income? A lot of Brazilians would say yes. They would say yes. They would even say that 15% is too low. Perhaps they would agree with the ICRICT proposal of 25%, which didn't pass, but then 15% is what we have. So on the principle basis, that's the justification behind Pillar 2. And I would not expect the representatives from the tax authorities to oppose it, because it increases, it carries the perspective, at least, of increasing revenues. It carries the promise of perhaps taxing more than they're taxing at the moment. If they adopt the IIR and or the UTPR, this even means taxing profits that they would not otherwise have taxed, because the DMTT is on profits earned by local entities, but the IIR, it's on profits from entities abroad. The UTPR is on profits from sister companies even. So the idea of increasing tax revenues is of course attractive. So I would not expect them to oppose it. But when you look to the rules themselves and you look at the way this was implemented, and also when you look at the process that led us from the program of work to the rules, to the commentary, to where we are now, we find deeply troubling aspects of global tax policy making that affect the domestic tax policy decisions of many countries around the world, including those in Latin America. The pitch of the OECD and of some developed countries, some of them in Europe, was, I don't know if it will continue to be, but it was, if you don't tax it, we will. So instead of you, for example, if you don't have a DMTT and you don't tax local entities at a minimum of 15%, we are going to impose that extra cost for investors that want to invest in your country, because they will have to pay this to us via an IIR or a UTPR. That's the pitch. The pitch is you better adopt this because this money is going to be collected. We don't know by whom. It could be by you or by another country. As I say in this month's article about CRISPR and biological assets, as I say in this month's article, that is a fallacy for three reasons. First of all, not every country is going to adopt Pillar 2. The countries that are going to adopt Pillar 2, many of them are going to adopt a QDMTT, so they're focused on profits earned by local entities. If you have a multinational group that has entities only in countries that have adopted a DMTT or a QDMTT, you should not be worried about IIR or UTPR. You should only be worried about the local QDMTTs. And also, in the countries that have adopted an IIR or a UTPR, you have all kinds of litigation opportunities. One of them is what I wanted to ask you about, which is the current state of the UTPR. For those that don't know, the UTPR it wasn't at the start, but it became the rule of last resort of the Pillar 2 rules as a backstop to the IIR. And the idea of what was once called the undertaxed payments rule and now is known as, the OECD carefully doesn't say it, but the EU says it, EU undertaxed profits rule. It's the notion that if you have a subsidiary, if you have a constituent entity in any country that has adopted a UTPR, that country is going to look at your multinational group across the world and see if, for example, in any jurisdiction, that entity in that other jurisdiction paid a tax of less than 15% on their excess profits. If that country has not adopted the DMTT, if no country has adopted an IIR, or if they have, but it hasn't covered all the tax that should be imposed under the rules, then you, the UTPR jurisdiction, can collect that tax. So this is very unique in terms of global tax policy design. It's very different from the way we understand and apply source and residence rules, which are sometimes very criticized, and I understand why, by many scholars. But my question to you is, now we are waiting for the Court of Justice of the European Union to issue a ruling, an opinion, on the future of the UTPR in the EU. And my question to you, first of all, is do you estimate that they're going to say it's incompatible, or do you think that they might say it's compatible? And the other point is, if they say it's incompatible, is this the end of Pillar 2? Because today, Europe is just applying Pillar 2 as is. All the rules, DMTTs or IIR, UTPR, and that's it. If the EU is unable, because of a decision by the Court of Justice, to implement a UTPR, would this be the last straw? Would this be the last thing in terms of, yeah, there's no real reason. If we can't do the UTPR, then, forget it. We're just not going to bother with this anymore. What's your view on that?
Well, to be honest with you, I don't think, or I don't understand why people they give so much importance to the UTPR. To be honest, I think the UTPR is quite irrelevant in a world in which every single country implements Pillar 2. And it was created for that, to be irrelevant. So I wouldn't even waste time trying to determine, whether this is compatible or not with treaties or with EU law. So even if the Court of Justice of the European Union say right now this is incompatible with EU law, it's not the end of Pillar 2 because you have the QDMTT. So and that's how this system of top-up taxes with linking rules, IAR and UTPR QDMTT works. Remember that the QDMTT was coming way after. Originally, if we were talking only about IAR and UTPR, I would say my answer is yes, it's the end of Pillar 2. If you don't have a UTPR, the whole system makes no sense. But when the OECD came with the idea of the QDMTT, I could say it was quite clever because it convinced countries you are going to get some revenues and don't let the British, don't let the Americans, to get those revenues for you. You can get them. Right, so it's a way for you to say increase your effective tax rate, which was ultimately what Pillar 2 wanted, right? So that's the purpose of the QDMTT. Of course, it has a lot of limitations because you need to follow strictly what the OECD says to be a qualified domestic minimum tax. But with the QDMTT there, and it's by the way all around the countries in Europe, the importance of the UTPR is really minimal. So I don't think that many things will change. Now, what can change is the perception of the validity and the legality of Pillar 2 in itself. And I think that is why keeping an eye on what is going on, with this decision in the Court of Justice is important, because if the Court of Justice is saying this is against EU law, then more challenges will come, right? And this demonstrates one thing that I said a long time ago. When you offer countries the possibility to have extra revenues, because if another country is taxing below the 15%, you can get those extra revenues. The reality is telling you that those revenues are really a fiction. One reason is because there will be a lot of litigation, so a lot of frozen revenues there around. So don't believe that you will get 30 million out of nowhere. Multinationals will go and will complain as they did it, with the UTPR. That's one reason. The other reason is perhaps, more policy reason to understand the dynamics of how this idea of extra revenue works. So let me take the example of the QDMTT. So QDMTT was created to convince developing countries to join the project. As simple as that. This whole idea of leveling the playing field, all of that's pure slogan. QDMTT was, listen, you don't need to come and believe that we are all treated in equal footing. Just come because you will get extra revenues. And when you travel and you talk with developing countries, they are concerned about those revenues, right? So it was a clever idea, get those countries in. Now, what is the problematic of the QDMTT from a policy perspective? When the OECD tells, if all the countries around the world, they have a 15% effective tax rate, that means you investors, will just happily pay the 15% in your country, so you will get those extra revenues. They forget about two very important factors. I would say two very important economic factors that they influence the behavior of investors. One of them is competitive advantages that you have as a country. So an investor goes to your country not only because you have a very low corporate income tax. They go because you have perhaps a very good infrastructure, a political stability, and et cetera, et cetera. You have, other ways to attract investor, they see the whole package, right? So that, together with the fact that not all the investors that react in the same ways to tax reforms, so elasticities of investments are not the same. And when you go to the literature, the economic literature on elasticities of investment, you will see that behaviors of investors are really, really different from one country to the other, from one industry to the other. So if we put both together, and let's say we go into the hypothetical that we have only two countries in the world, both now they implement Pillar 2, both will tax with 15%, but one of those countries has almost no other competitive advantages vis-a-vis the neighbor country, except for the attractiveness of the corporate income tax system. I don't see a reason why those investors will remain in that country when Pillar 2 is implemented. They will move to the neighbor country, because the neighbor countries, if both now tax you with 15%, the whole reason to be there disappears, right? And that shows that the decisions of investors are dynamic decisions, are not static as the OECD is trying to show it. It's not a photograph telling you, listen, as soon as everybody is implementing this, you investors will behave, in this way. They won't consider anything else. No, they will look at all the competitive advantages in neighbor countries. They will look at their own capacity, to react to a tax reform of this nature, right? So elasticities of investment, competitive advantage will play a major role. So that's why in this article I wrote in 2024 for Columbia Journal of Tax Law, I said, I call this the revenue myth, because it's a myth, right? When you offer a developing country $90 million, extra from QDMTT, the reality is that they won't get a fraction of that for many of these factors, right? So that is, to a certain extent, a little bit evil to do, because those countries, they need those revenues, and they will think. I mean, I've been advising different developing countries, and when you talk with finance minister, they almost already start counting that money for the next budget. How much money we have, how we can use that. At the same time, they will realize that they will have a big hole there, because either those revenues are frozen somewhere in a court of law, or because those revenues will never arrive, because if you don't have investors, you don't have corporate income tax revenues.
Yeah, I completely agree. I think that the risk of losing investments is very real. I don't see the minimum tax of 15% per se in a vacuum as a reason for you to flee a country and divest from your holdings. But you're correct in the sense that if there are other countries in the world that offer similar investment opportunities and don't have that rule in place, then that becomes a consideration. And then all of a sudden it becomes part of your planning, and you should take that into account. You have a responsibility in relation to your shareholders to maximize opportunities for you to make profits and for you to deliver a return. I would say, though, that the pitch for countries, not in Europe, but in other places of the world, to implement a QDMTT is twofold. One, if you don't implement a QDMTT, some other country might tax those excess profits via an IIR. And if no country does that, another country might tax them via the UTPR. I think most countries will have a version of a DMTT or IIR in place, and they will at least be in a position to collect those taxes via those two rules, leaving the UTPR more for the academics and the courts to discuss than an actual specific case in which the UTPR is imposed. But it is something that is currently under discussion at the level of the Court of Justice. Another point that I just wanted to mention is a lot of people think that the litigation opportunities relating to Pillar 2 are just, for example, the violation of the UTPR in relation to tax treaties, or the violation of the UTPR in relation to the Constitution. There's so much more in the rules that you can use as a basis for litigation. And I've written a few articles about those opportunities for you to discuss aspects of the rules. The recent article that we published on Tax Notes, it's about the notion of natural resources and the definition of natural resources. You could push the courts of specific countries to consider the definition of natural resources as encompassing biological assets. So, for example, crops and livestock, because they are equally tangible, they're equally connected to the territory of the imposing jurisdiction, and they should be factored into the SBIE. And if they are not factored into the SBIE, that could be a violation of the taxpayer's ability to pay. Also, about a violation of their ability to pay, something that I hear very little about, the excess negative tax, especially of Article 4.1.5 of the rules, which is a tax that can be imposed even if you don't have any profits in that year. If you don't have any profits, if you don't even have any globe profits, you might have to pay that tax because there's a difference between your deferred tax assets for accounting purposes and globe purposes, and therefore you pay that tax, or you have the ability to postpone the payment of that tax. What I say in an article that I wrote a few months ago is, if a company says, I do not want to postpone, and the tax authority says, okay, pay the tax, the company can say, I'm not going to pay the tax because I don't have income. The tax that you're imposing on me is a tax on income. I don't have income. Therefore, you should not be able to impose that tax on me. And many other opportunities I cite, for example, and this varies from country to country, but some countries, and the OECD even recognizes this, some countries allow you to deduct certain tax penalties. Certain types of tax penalties are considered deductible, other types are not. The OECD in the Globe Rule says that policy disallowed expenses include those that are above 50,000 euro. And that's it, 50,000 euro, regardless of the type of the fine, the type of the penalty. If it's above 50,000 euro, it's considered non-deductible for purposes, again, of this top-up tax, which is a tax on income. My point is, your jurisdiction, wherever you're watching us from, your jurisdiction probably has guiding principles of your tax system. Guiding principles that are present in different taxes and are present in different parts of your tax legislation. If it's a tax on income, and for the other taxes on income in your jurisdiction, certain types of penalties are deductible, why are they not deductible for this tax on income? There's no justification apart from the fact that you have accepted, massive quotation marks, you have accepted that the OECD should establish those rules for every country to follow. When you read the law of, and I cite the example of Brazil, but you could find that in many countries as well. Different countries have different practices, but in Brazil, you have one law, 15079, which contains the rules of the QDMTT, and you have a massive regulation, many times larger than the law itself and longer than the law itself, that contains all sorts of rules that are not specifically mentioned in the law. And Brazil says, both in the law and the normative instruction, they say that if the OECD changes the rules, the normative instruction is going to change the rules as well. And then for anybody that is a tax policy enthusiast or a tax lawyer or a legal professor, whatever, you say, well, wait a minute. What I mean, you're sort of bypassing a very important step here, which is, why are we, like, the OECD decides it, and then all of a sudden you adopt it? Well, wait, what's it? And we don't get a say in it? Like the constituents don't get a say in it. I say this too. I wrote a post about this on LinkedIn. It's a shame it's not an article. It should have been an article, but it's a post on LinkedIn in which I just looked at the session in the Senate of Brazil that approved the QDMTT. It took 15 minutes, 11 of which were spent by the reporter of the project, of the bill of law, reading it, just reading the report in which he cited best practices, new international standards, abiding by the G20, and so on and so forth. And then for 4 minutes, there was a very quick debate about one point of the law. And then the president of the Senate said, those that approve the law remain as they are. 1 second later, he said, it's approved. That's how the DMTT was approved in a member of the G20. I'm not even talking about a very small country, a tax haven. This was approved by a member of the G20 like this in the Senate. I ask you, is this representative of the will of Brazilian constituents? I don't know, because they haven't really, most of them don't know about the Pillar 2 rules. Most of them don't know the specifics of what it's going to bring to the government. And so all of these aspects of global tax policy making are relevant for us because the minute we accept the premise that the OECD is going to implement certain standards and we're going to follow them, this can have implications for other parts of our tax policy as well. And
let me
on
just
that top,
yeah.
yes.
Just
Yes,
a very small point on that, because I think the message is very important of what you are saying, Lucas, because I've seen this in other countries as well, and I have perhaps the same reaction that you have, which is a reaction of surprise. How, in which moments we countries around the world accepted that the OECD moved from offering best practices and giving reports like the tax competition report in 1998 or Action 5 in BEPS to actually designing laws that they are drafted to be implemented exactly as they were drafted in an office of bureaucrats in Paris to the rest of the world. And then parliaments around the world, that they generally play the role of really shaping the laws in different tax systems, they play no role and they have no say, because things as they are, if you don't follow strictly the global rules, your DMTT won't be a QDMTT. Best example to show you is that you have no say here, because if you dare to deviate a little bit of, so as Colombia did it, you deviate a little bit from what the OECD is saying, that means that is not anymore a qualified domestic minimum top-up tax. These acronyms, that we learned in the last years, it's just a DMT, so it has a difference, will be another covered tax for purpose of Pillar 2. Now, look at how the narrative changed in terms of tax competition from 1998 to now. 1998, everything was about, listen, I'm going to tell you, you can compete. Tax competition is not always bad, but there is something that we will denominate harmful tax competition. Don't go there. Don't do these things. If you do these things, that's harmful. If you do these other things, that's not harmful. And that was indeed the message, I could say, up to 2015, when the Action 5 final report came out as well. If you remember the whole discussion about IP boxes, it was framed in the same direction, right? Harmful practices and non-harmful practices. And suddenly, 2018 on, that changed. Every single form of tax competition, corporate income tax competition, was per se considered as negative. In other words, the premise was very simple. I presume that if you have very low corporate income tax rates, that is because you want to attract non-substantive investments. Is that really true? I mean, just to give you, a random example that I remember from a presentation I did for a group of tax policymakers in Nigeria. Nigeria, they have, these tax incentives called pioneer status incentive. And I look at the numbers, how much investment they attracted. Only looking at the first quarter of 2024, it was around 70 million pounds that they attracted in real investment. They have companies, that they employ people. They have different factories, that they were built during that time. So is this really a sort of incentive that doesn't work? I would say absolutely not. Is going to reduce the effective tax rate? Yes. It's going to be affected by Pillar 2? Yes. Probably Nigeria has now the pressure of saying, we cannot offer the pioneer startup investment anymore. We need to offer something else. And that put also pressure on what else are you going to offer, right? in the big picture, tax systems are not only isolated parts of corporate income tax, VAT, personal income taxes. They are seen as a whole. So what is a natural reaction of countries starting to offer exemptions in other areas, VAT, personal income taxes? And then I always say, be really careful with that, because where your money comes from is not from corporate income taxes. It comes from personal income tax, it comes from VAT. If you start touching those taxes, then you will be in big troubles. Your wallets will be in big troubles. And then pushing things a little bit further, and with this I get back to you, is the idea of, if we have to compete outside corporate income taxes, we have two questions. One is, not all countries can do that, and this is an obvious thing. Not all countries, they have the same competitive advantages. So voila, that's the reality. Brazil is not the same than Indonesia or Vietnam or France or Germany. So something that we can see without being expert on anything. So competition outside taxation won't be the same, because countries, they don't have, the same competitive advantages. And I would say the second important thing there is that pushing countries, to compete outside corporate income taxes, or outside, let's say, taxation in general, like the OECD is doing with Pillar 2, which is competing with subsidies, raises a very fundamental question, which is, who says that a tax incentive is worse than an arbitrary subsidy that is given by a government? So how these bureaucrats in Paris, they think is like, of course, everybody is like the French or the Germans, but I would say, go and visit Latin America. Go and visit, some countries that they suffer from corruption, and you are inviting those countries to offer money for companies to go and invest there, rather than perhaps having a tax incentive in the law, very clear. You come here, you have to pay, let's say, 5% rather than 20% of corporate income tax. I still don't understand where this idea, beyond, of course, of a pure ideology, is that subsidies will be necessarily better than tax incentives.
I think your points are great, Leopoldo. I would say that I know that the Latin American tax authorities and Latin American governments have been invited to participate in discussions with the inclusive framework, with the OECD. They're part of the inclusive framework, but also the OECD members and the G20 members. So I know that they are part of those fora. I don't know the weight of their influence, and I would like to sort of take Brazil out of the equation, because Brazil is a large country. Brazil is a member of the G20. I'm thinking of Bolivia. I'm thinking of Paraguay. I'm thinking of Honduras. I'm thinking of the smaller countries in the region, and whether they have a say, and maybe they don't have a say. And what does that mean in terms of designing your own tax policy? The other point is, and this is something that you see also in many discussions in IFA and other places, is that this is a public interest. This is a project of public interest, because you should have a minimum tax on multinationals, and you should have a way of ensuring that that minimum tax is paid. I agree with the premise that companies should pay some income tax. I don't know if it's 15, it's 20, 25, I don't know, on their profits. I agree with that premise, yes. I question whether the methods that we're choosing to follow to find that money, that fictional money, are valid and legitimate and in accordance with our legal systems. And if they're not, you will have litigation. You will have lawyers who are watching us right now and designing those strategies. And in Brazil, I remember that there was a statistic, there was something that was produced a while ago that said that per tax foreclosure, from start to finish, per tax lawsuit, let's just put it in broad terms, it's the cost of just the process of making the lawsuit go from administrative court all the way to the Supreme Court would be about 35,000 Brazilian reais, which today is like $7,000, or maybe $6,500 per lawsuit. One lawsuit would cost that to the machine, to the state. And then if you add to that all of the lawsuits, all of the discussions that are going to take place, this is going to happen. I'm not even talking about treaties, which is a completely different chapter. And you could talk about treaties in relation to the rules as well, not only the UTPR, but also the IIR. Some authors have written about that as well. So all of that should be taken into account before you come up with a number of what those tax authorities should expect. And just one point about one question that we received. In the Q&A section, the person that asked the question says that the reforms of the GLOBE rules have benefited few countries, especially developed ones. They cite the UTPR safe harbor, the treatment that was given to some companies, and the GMT right now is poised to continue benefiting primarily one country, the United States, if the side-by-side system goes through. And the question that they are asking is, should developing countries take advantage of these waves of reform and change the treatment of their own tax incentives? And if so, if they don't do that, what would be the reason for the inaction of those countries? I would say, and then I'm going to throw it to you, Leopoldo, I would say that I completely agree with the idea of revising your tax incentives to make sure that they deliver the benefits they were designed to deliver. I completely agree with that premise. You should revise your tax incentives to make sure that they're effective. Now, in doing so, you might do it in many different ways. You might do it, for example, instead of just giving money, you might just condition a deduction, or maybe say you should have an investment in intellectual property, a development of a patent. You have many different options in terms of choosing your tax incentive design. I would argue that limiting your choices to what the OECD believes is the appropriate kind of tax incentive for the GLOBE rules is illegitimate. And it's a violation of your sovereign right to decide what works for your country, because at the end of the day, you want to bring investment in. Your country has limited resources, sometimes limited land, limited workforce, and you need to be creative. And especially something that we haven't touched on, the governments in charge of those countries, if they are democratic, won't be there forever. So they're thinking of something that is like short to medium term at best. And even better, short term, something that can deliver benefits right now so that they can use that money to pay for public expenditure that is relevant for their constituencies right now. You can't ask those governments to commit to something that might deliver returns in the future if it delivers those returns. So my question to you, do you think that Pillar 2 is an opportunity for countries to revise their tax incentive policies?
Absolutely. And I have said that before. I think one of the positive things of Pillar 2 is precisely that, yes, it put pressure on countries and different angles, but one of them is the idea of tax incentives. And let's also recognize that many developing countries, they have good tax incentives and other tax incentives that they simply don't work. And they don't work for a very simple reason. There is no proper monitoring of how much investment comes from the country once the tax incentive is implemented. So in the reality of developing countries, what happens in at least in the experience I've seen in practice is that they implement the tax incentives and they forget about it. Said investment will come, that's it. There is no monitoring, there is no capability as well, to really monitor, what's going to happen 10 years later, 5 years later. So this is perhaps, a good momentum. Pillar 2 is also presenting that momentum to say, okay, now that we need to accommodate to the new rules, and those new rules invites competition in some specific areas, and substance, substance-based income exclusion with payroll, with tangible assets, subsidies in certain areas. Perhaps now is the moment in which we can really think, okay, we have, let's say, 10 different free trade zones, are they really working? Do we need to modify, what aspects of these trade zones to make them not only compatible with Pillar 2, but to reinforce the competitive advantages of the country? So this is also an invitation for countries to think, how do we see each other in the next 10 years? Do we want to be a tech hub? We want to be what sort of country in the next 10, 20 years? And I would say that is perhaps, something that we could take from Pillar 2 as a good opportunity, because I foresee the future in the direction of competition going for innovation and perhaps institutional quality, because we are being forced to that, and that is a positive aspect of this thing that is happening right now. So answering the question is yes, this is a fantastic opportunity for countries to do that. Now, is the OECD the legitimate actor to force countries to do that? That's a different question, right? I would say,
Yes.
of course not.
Yeah.
That's not the way to do things, and countries should not necessarily accept that as something, granted, right? But it presents an opportunity. Now, if we talk about the legitimacy of the OECD to do this, and perhaps, to move further on these matters, there is something that needs to be done. And I want to take the opportunity here to reinforce the importance of what is going on at the United Nations, because of precisely the breaking point to which the OECD has forced countries to arrive with the inclusive framework, which is everything less inclusive, and how tax policies are being generated, from a city in Europe to the rest of the world. So what is going on at the UN goes beyond of just a simple transition from OECD to the UN. It's a matter of counterbalances. It's a matter of powers. We cannot have a single institution monopolizing the debate in international tax policy, and that is not healthy. It's the same when you look at the reality of a single country. Imagine that you have one single party telling, the citizens what to do, what not to do. That seems not to be healthy. It's not democratic. It's against the idea of diversity of thinking. So here is exactly the same. We achieve a point in which, for so many years, and I could say, I'm going to praise as well the work of the OECD, very good technical work, particularly in matters of transfer pricing and tax treaties. But going from that idea of I'm going to help, countries to do best practices, to I'm going to design policies for countries to implement exactly as I designed it, in my office in Paris, is a very different story. So yeah. My message for developing countries would be not only look at what's going on at the UN, take the opportunity to participate with your voice. This is different than the inclusive framework. It's not only about sitting and following everything from the TV of the United Nations. Go there, participate in the negotiations, see what matters to you. You have the opportunity to create new protocols on matters that are relevant for your country. And this is something that is a golden opportunity in my view.
Thank you very much, Leopoldo, for your insightful comments on this topic. We're running out of time. Just one comment from an anonymous attendee. He says that the hypothesis about tax incentives is that the developing countries are not as organized as a group as developed countries, which is why sometimes developing countries don't find ways of making sure that their interests are heard, respected, and accommodated in the rules. So I would agree with that assessment. I think that if you read my next month's article about the backstage negotiations of Pillar 2, you will find that the OECD was very focused on obtaining the support of the G20 because, and this is expressly said in what I review in the next article, this is expressly said because they wanted to use the G20 to put pressure on developing countries. So they wanted to use the G20 seal of approval to put pressure on other countries saying, hey, this was approved by the G20. This is not just an OECD project. This is an OECD and G20 project. Read the first articles. I think it's Article 2nd of Law 15079 of Brazil. And you will see that it says it's a project of the OECD and the G20. That and the G20 is a very important part of the process because they see the G20 is the best of the both worlds because it's a small group, but it's representative of economies in different parts of the world, and it has members of BRICS, as well as the European Union, as well as the United States and China. And so if you gather all of those and you say the G20 has approved it, the G20 has supported this, then you get to where we are at the moment. Now, it's the final message from my side would be, some people say that we should not be as concerned about the entrenchment of the OECD in our tax policies with Pillar 2 because it already happens in other areas of tax law. For example, transfer pricing. For example, our tax treaties follow OECD model convention, so on. And what I would say to that is, first of all, your premise, if someone says we shouldn't be concerned about that because we already accept the others, your premise is that we accept the others and we're okay with them. I'm not okay with the influence of the OECD transfer pricing guidelines on the transfer pricing policies of many countries. I would say that in many parts, the transfer pricing guidelines are subject to discussion and perhaps to a review and to individual policy choices. I would say, though, that there's a key difference between those and Pillar 2 at the moment, which is, for example, in the case of transfer pricing, you could make a case that not adopting the same set of guidelines would be an impediment to the regular flow of trade and business. So if you adopt the same guidelines, at least you know that country A is going to collect this tax, country B is going to collect another tax. Both countries agree with their tax charges, and case closed. In the case of Pillar 2, differently, first of all, the argument for Pillar 2 is if you don't collect this tax, someone else will. So it's not about respecting the flow of trade and business. It's basically there's some money on the table and it will be yours if you implement this rule. If it's not, then someone else is going to take it. And then tax administration just implement it. Just say, well, it's better to be prepared, right? It's better to play, as said in Brazil, by the rules of the game. So you have to play by the rules of the game. So that's one difference right from the start. And the other difference is, in the case of transfer pricing, all you're really doing is you're reallocating or appropriately allocating, depending on who you ask, the profits of multinational enterprises or transnational business. So instead of being completely taxed here, it's going to be taxed there and so on and so forth. And you want to make sure that if they are taxed in different countries, that they are appropriately taxed. In this case, in Pillar 2, you're not reallocating so much. What you're doing is you're making sure that they have at least a certain level of tax imposed on their profits. And that level of tax may not be the effective tax rate in place in many countries. So what you're doing is you're creating, as Leopoldo said brilliantly, you're creating this sort of fictional money out of thin air. So it's just that there's more money. And as a professor said to me a few years ago, there will always be budget items requiring more money. You will always find an expense that you could use more money to fund in local budgets. So there will always be reasons for you to collect more money. And essentially, what they're saying is there's this other money that you're not collecting now, and you can collect it with the imprimatur of the OECD and the G20. So it's not just you, as was said in Brazil, and I'm sure is said in many countries. I'm going to be looking to what Uruguay will do and what the Uruguay parliament will do about this. But in Brazil, it was said, no, this is being done by every country. This is a new standard. This will be important for our reputation in the world. And therefore, it's important for us to adopt it, So think that perhaps my message, and then I'm going to throw to Leopoldo for final words, but my message is simple. Think about what adopting Pillar 2 means for the future of tax policy making. Think about the process that led us to this point of thinking, are we doing this just because of the sunken cost? Or are we doing this because there's a reason for us to do it? So think about this. think about what we dodged with Pillar 1. We haven't talked about Pillar 1 because it's not the topic of this conversation, but Pillar 1 could have been in place. Imagine the litigation and compliance and the hours and the days and months of compliance work that would be associated with Pillar 1 if we had implemented Pillar 1. Now we're handling that with Pillar 2, and every day that we continue accepting Pillar 2 as a sort of foregone conclusion, it's another day that we accept the rules and we accept their consequences. That would be my final message. Throwing to you, Leopoldo, for final words.
Thanks, Lucas. I could just give a very simple message as final words. I would say that the G7 agreement is probably giving an opportunity for the developing countries, particularly Latin American countries, to wait and see. Because they can be in a quite interesting position in the case that they decide not to do anything about Pillar 2, which is that investment coming from the US to Latin America directly, not passing through any other part of the world, can be quite interesting for countries, that they don't have Pillar 2. So the position right now is, let's see how this side-by-side system will look like. And after that, perhaps that's a better time to decide. Now, in a more holistic message, I could say Pillar 2 is giving us an opportunity to reflect perhaps that international tax policy is very complex. And at the same time, I could say we need to understand, and I'm going to take some words I wrote in a column for El País in Uruguay not so long ago. But at the same time that we say, that international tax policy is about cooperation, it's also about competition, and is multilateral, but at the same time it's also unilateral. And the challenge is to understand that we live in this reality. Look for your interests as a country, because the challenge is not to question whether Pillar 2 complied or not with what they promised, which was this idea of leveling the playing field. Clearly didn't do that, right? But the challenge is how countries in the region, they adapt from now on in the future to navigate in this very complex scenario. And that scenario is showing us that not everything is black and white. Things are simultaneous, multilateral and unilateral, cooperative and non-cooperative. And that's the reality that we need to understand behind, the idea of international tax policy. So perhaps this is what I could give as the main message, for the countries of the region right now.
Excellent. Thank you very much, Leopoldo, once again for your time and for your very insightful commentary on Pillar 2. Thank you all for those that have attended, whether on Zoom or YouTube. This is going to be available later on our platform as in the section of webinars. And thank you once again, and hopefully we'll have more content about Pillar 2 coming up in the next weeks or months. We'll be looking towards the new side-by-side solution if it appears, if it is issued, and when it is issued. Thank you very much once again. Thank you, Leopoldo. Bye-bye.
Bye-bye.